financial management. Financial management, ladies and gentlemen, is a key paper that disturbs many students who are doing these CASNEB exams. But of course, that will not be your portion because your paper is really, really easy. Especially if you have been at RCM, I don't see why you should be able to fail. Now, ladies and gentlemen, please listen and listen to me very well. If your examiner wants to confuse you, he'll bring these questions on making changes to credit policies. That the current credit policy is that we're giving you 30 days to pay. And we realize that many of you are not able to pay in good time. So then we incentivize you. What if in this case here we give you like a discount, trade discount of say 1.5%, but you pay say within 10 days. And then we monitor what is happening. If that happens, I'm telling you, so many guys get very, very confused. So, and as I've said, that can never be your portion. Never, never. So I want to share my screen and take you through something very important for you this semester regarding what I've just explained. So this is RCM College. For those of you who want to join this college, of course, this is our usual number, 0719 525,000. And of course, we are the best college in East Africa. And we are looking at changes in credit policy and the MILLER-ORR model. I will start with MILLER-ORR model. And the MILLER-ORR model is in part B of this question I'm sharing here. For 5 marks, part B, they're telling us Renpec company, a subsidiary of Ulnad company, has set a minimum cash balance of 7,500. The average cost to the company of making deposits or selling investments is 18 per transaction. The standard deviation of its cash flows is 1,000 per day during last year. And the average interest rate on investments is 5.11. The average interest rate on investments is 5.11%. So they want us to determine the spread, the upper limit, and the return point for the cash account of Renpec company using MILLER-ORR model and explain the relevance of these values for the cash management of the company. So ladies and gentlemen, if I got this kind of a question today, even in an exam room, I will straight away have some dancing moments. Yes, I will dance. I will dance. Yeah, I will dance straight away. So then the very first thing that I will do is to calculate the spread. So let's calculate the spread together. We calculate the spread together. So for me to be able to calculate the spread, what do I need? What items do I need to be able to calculate the spread, my good students? Of course, you're reading your paper. So number one, we shall need what we call the daily interest rate. Daily interest rate. Very important. So the daily interest rate, I can see in this question, they have given me 5.11%. But you see, this 5.11% will be an annual rate. But unless you're told otherwise, the rate given there shall be assumed to be an annual rate. And again, for those people who have been in investments, we know that these investments will give you what kind of interests per annum? It will be like 9%, 10%. So you can't get this 5.11 being a daily rate. This must be a per annum rate. So then come here and divide this by 365. So you take 5.11 divided by 365. What are we getting there, ladies and gentlemen? So 5.11 divided by 365. You simply take 5.11 divided by 365 days in a year. Divided by 365 days in a year. So we are getting 0.014. So you're getting 0.014%. So remember, even this 0.014%, if you don't want to confuse, it will be very important for you to get like this figure without percentage. So you go to your calculator and you say 0.01 divided by 100. Can somebody in this case here do this? Say 0.014 divided by 100. Tell me what figure are we getting? I'm so sure in standard form, they must be giving you 1.4 times 10 raised to negative 4. Standard form. So when they give you this in standard form, what do in high school? You were told you count 4 zeros. 4 zeros, this negative 4 zeros. And then write this number, 14. And then in between the first 2 zeros, you put a decimal. In between the first 2 zeros, you put a decimal. So we have here 0.00014, like that. So is that okay up to here, ladies and gentlemen? So if, for example, they tell you 1.8 times 10 raised to negative 6, for example, you simply write how many zeros? These are 3. You write 6 zeros. And then you write 18 without putting a decimal. And then in between the first 2 zeros, you put a decimal. That is very, very important. So up to here, ladies and gentlemen, are we kimoja? Are we together? Up to here, are we together? Please confirm. Thank you very much. Up to here, we are together. Thank you very much. So the first thing for you to be able to get the spread, you need the daily interest rate. Then from there, ladies and gentlemen, the next thing is you to give us the variance. Give us what we call the variance. Give us the variance. Give us the variance. So come here and they give us the variance. So how do we get variance? It is standard deviation squared. So has this examiner given us any standard deviation there? Oh yes, he has given us. Let me just share this on my screen. So you can see here, they have told me, and the standard deviation of its cash flows is 1,000 per day. Remember, it must be daily, eh? It must be daily. So it's 1,000 per day. So then the variance will be 1,000 squared, which gives us a million, which gives us 1 million. Ladies and gentlemen, the other thing that I would expect is the transaction cost. Transaction cost. Yeah. So have they given me the transaction cost? Remember, this one will not be per day, but per transaction. Per transaction. That is the only one that goes against the daily thing. So the average, up here, yeah, that for us to be able to buy and sell these shares, you can see making deposits or selling investments is 18 per transaction. 18 per transaction. So this is 18 per transaction. Very, very important. 18 per transaction. And then now you can come up here and now give us what we call the spread. So you give us the spread, which will be 3. Inside these brackets, once you write 3 there, you'll be able to write for us the formula, which will be 0.75 transaction times variance divided by the interest I. Yeah, and then raised to a third. So to get the spread, you take 3, and then inside here, you'll be able to do some abracadabra. You take 0.75 times this transaction cost. This is what we call T, times the variance divided by capital I, where capital I is the daily interest rate. So then this one will be 3 times we have 0.75 times 18. Remember that our variance was 1 million divided by our I, which had 4 zeros there, and then 1 4. I think it was like that. And then whatever we shall get, we raise this to a third. Whatever we shall get, we raise this to a third. So you start with what we have in brackets. In brackets. We start with what we have in brackets. Yeah, so we have here 0.75 on 0.75 times 18 times 1 million divided by 0.00014. You say first equals. Whatever I'm getting, I will say raised to. I open brackets. I say 1 divided by 3. I close brackets. Then I say equals. So what figure are we getting? I'm getting here, inside here, I'm getting 85.66. So times 3, at the end of the day, I'm getting 13,756.98. Is there somebody who is able to get this figure? Anybody who is able to get this figure? Yeah. So I saw a question up there. Let me first of all handle this question. Yeah, a third. You know, the moment you say you are raising to a third, that is okay. But if you wish, you can as well put in brackets. And then, I don't know, maybe in your class you used here 3/4. You see 3/4 is the same as 0.75. 3/4 is the same as 0.75. So now that we have gotten the spread, now we can easily get all the other things, knowing that we have a lower limit. So this examiner has given us a lower limit. Are you able to see the lower limit? Is there somebody who is able to see the lower limit of 7,500? Yeah, lower limit is 7,500. Yeah, so therefore the upper limit will be the lower limit plus the spread. The lower limit plus the spread. So then in that case here, we have 7,500 plus that 13 something. So we have 7,500 plus 13, 756.98, which will end up giving us some good number there. What number are we able to get there? So 7,500 plus that 21. Mm-hmm. 21, 256. 21, 256.98. Yeah. And then number 3, they wanted us to give them the return point. They wanted us to give them the return. All right, so they want us to give them the return point. Return point is really easy. How do we get the return point? This is really, really easy because already you have everything. So anytime they want us to get the return point, we normally take the lower limit plus spread divided by 3. Lower limit plus the spread. Yeah, so we have our lower limit, which will be 7,500 plus our spread, which is 13,756.98. This one only is the one that you divide by 3. That one only is the one we divide by 3. So 7,500, 13,756.98 divided by 3. So then this is 12 point something, isn't it? 12 point something. 12,000, 085.66, or thereabout, even 12,086. So perhaps this formula could be new to you, but my question will always be, have you been able to master now this concept of Miller-ORR? How to get, in this case here, the spread, upper limit, and then we have, in this case here, what here? The return point, where you return. Have you mastered it? Do you think now it's something you can go and study? Especially that I. That I, when it's 0 point something percent, it confuses students. Sure, you divide, and sure you divide. But you see, the examiner also wanted you to explain those terminologies. Yeah, the examiner wanted us to say what they mean. Relevance of the values. So the relevance of the values, the relevance of the values, the relevance of the values, the relevance of the values. We are told here, Miller-ORR model takes into account of uncertainty in relation to cash flows. The cash balance of RENPEC company is allowed to vary between lower and upper limits calculated by the model. If the cash balance reaches the upper limit, yeah, when you realize that your cash that you have is really very high, what do? You buy shares, you buy securities to reduce your cash balance. So upper limit, the firm buys sufficient securities to return the cash balance to a normal level called the return point. And when the cash is depleted, yeah, when you realize in this case here, your cash is really being depleted in the company up to the lower limit, then you sell the share. So keep on doing that. So when the cash balance reaches the lower limit, the firm sells securities to bring the balance back to the return point. The Miller-ORR model, therefore, helps RENPEC company to decrease the risk of running out of cash while avoiding the loss of profit caused by having unnecessary high cash balances. So like now ourselves, in this case, ladies and gentlemen, at the college here, we normally get what we call our upper cash limit whenever we open. Like right now, we shall be opening for the next semester on the 1st of September 2025. Next semester, 1st September 2025. And of course, that is the day when we shall be able to collect most of our cash. Plus the day, of course, when exams are released. Whenever exams are released, we also get to collect quite a lot of cash. So then when we reach this upper limit, what do? We either, and exceed it, we either buy shares to get cash from our bank. Remember, bank balances, it doesn't matter how high it is, the bank can never give you any return. That's a current account. So then we will be able to transfer this money either by shares, or we transfer it to what we call money market funds, like CIC, etc. Yeah, and then the moment we continue the semester, of course, now obligations are catching up, lecturers are being paid. When we realize that we are now running out of cash, what do? We go back to those shares, sell them. Yeah, like the treasury bills. They are very good because they're short term. You sell them or you realize them in 3 months, and then you continue like that. So Miller-ORR model, you are required to know how to compute it and how to explain it a little bit. So then have you now mastered, ladies and gentlemen, something called Miller-ORR? Have you mastered it? Have you mastered it? Thank you so much. Then now we go to part A of this question, which is really something that is really, really nice. I love it. I love this. I love it. I know students hate it, but I love it. Personally, I love it. This race is not for the faint-hearted. It's not for the faint-hearted. So now we go to part 1, where they want us to evaluate whether the proposed changes in credit policy will increase the profitability of ULNAD. Very easy. This I'll be able to get all the marks even without knowing what I'm doing. I'll be able to get all the marks. So I'm told here ULNAD company has annual sales revenue of 6 million and all sales are on 30 days credit. Although customers on average take 10 days more than this to pay. Contribution represents 60% of sales, and the company currently has no bad debts. Accounts receivable are financed by an overdraft at an annual rate of interest of 7%. ULNAD company plans to offer an early settlement discount of 1.5% for payment within 15 days and to extend the maximum credit offered to 60 days. The company expects that these changes will increase annual credit sales by 5%, while also leading to additional incremental costs equal to 0.5% of revenue. The discount is expected to be taken by 30% of customers, with the remaining customers taking an average of 60 days to pay. So they want us to evaluate whether the proposed changes in credit policy will increase the profitability of ULNAD company. You see, we have an existing policy. And this existing policy, if I were you, first of all, I would want to know what is the current average collection period. Current average collection period. That's where we begin from. Before we look at the proposal, before we look at the change, we start with the current. Very easy, very easy. So come here and give us the current average collection period. Current average collection period. Yeah, so please read here. You see, we are told that ULNAD company has an annual sales revenue of 6 million and all sales are on 30 days credit, all sales. Although customers on average take 10 more days than this to pay. So then the average collection period will be 30 plus the extra 10 days, which gives me 40. Gives me 40. Then, ladies and gentlemen, go ahead and give me the current accounts receivable from this 40. Give me the current debtors or the current accounts receivable. Current accounts receivable. How do we get this? It's very, very easy. We know our total credit sales. They have told us our total credit sales will be 6 million. So this 6 million is what I apportion using the credit collection period out of 365. So you're selling 6 million in a year, but of course we expect at any given time, at the end of the year, we expect to be having 40 days of these sales as receivable. So 40 over 365. So then this gives me what figure, ladies and gentlemen? So whenever we sell, we realize that we shall be paid on average in 40 days. So by the end of the year, yeah, we expect whatever sales we have, 40 day sales will be carried over to the next year, which somebody is giving me a figure of 657, 300, 657, 500, and what year? 34. Yeah, 657, 534. 657, 657, 534. They are dollars, US dollars. Very, very good. Very, very good. Yeah, 534. Yeah, you guys can write decimals, but for my case, yeah. So, ladies and gentlemen, from there, this is a very, very easy question. Then we go straight away to the proposed policy. Tell us in this case here, what is the new collection period under the new policy? The new, very easy, easy peasy, new collection period under proposed policy. Under proposed policy. Yeah. Yeah. So under proposed policy, what have they told us? You have to be very, very careful, Beverly. It's not all customers who will take 60 days, but I appreciate your attempt. But not all customers will. Normally, this is an average. This is normally an average. Yeah. So you can see down here, Ulna, the company plans to offer an early settlement discount of 1.5% for payment within 15 days. So we want in this case here to entice and to extend the maximum credit offered to 60 days. The company expects that these changes will increase annual credit sales by 5%, while also leading to additional incremental costs equal to 0.5% of revenue. The discount is expected to be taken by 30% of customers. So 30% of the customers will pay within 15 days. 70% who are the remaining will now pay within 60 days. 60 days. Now, because of this incentivization, we are told that we have 30% of the customers paying within 15 days, and then 70% will now pay within 60 days. So then we have, ladies and gentlemen, the new collection period under the proposed policy. Yeah, because 30% are going to adhere to this rule, and then they pay within 15 days. But the other ninjas will pay in 70 days. Yeah, or 70 days, not 70, but 60 days. And that chance is 70%. So can somebody give me this number? Can somebody give me this number? I'm being given a figure of 47. Yeah, don't round off too much as well. Don't round off too much as well. 46.5. But now remember, they have told us that once we bring this kind of new policy, our sales will increase by 5%. So can you kindly give me the new credit sales? New credit sales. So remember, the old was 6 million. And we expect this to increase by 5%. That is what they have told us. We expect this to increase by 5%. We expect this to increase by 5%. Yeah, I'm not dreaming. I'm stating what is here. Let me come back to this question. Let me come back to this question. So what have they told us, ladies and gentlemen? They've told us here that the company expects that these changes will increase the annual credit sales by 5%. Yeah. Yeah. So, and remember, our initial revenue was 6 million. So that will give me, somebody's telling me that this will give me 6.3 million. Thank you very much. Yeah. Because you have extended the period. Then come here and give me the new accounts receivable. The new accounts receivable will be our new sales now times our new number of days divided by 365. Remember, this will be sales per day times those number of days. So give me the new accounts receivable. Give me the new accounts receivable. Given our good gesture, given our good gesture, what will be our new accounts receivable? Our sales have gone up. The number of days have gone up. Most people are happy. They want to buy now things from us. So in this case here, I'm being given a figure of 802. Nancy, check. 802, 602. 802, 602 point something. I can just take 802, 602. So in this case here now, we suffer as a company Yes, our sales have grown, but we're going to suffer immediately because our credit facilities will be stretched. We're going to finance a bigger receivable. Most of our money will be outside there. So give us the increase in finance cost. Because of this, give us the increased finance cost. Interest. This is interest. Interest, very easy. So my new receivable is 802, 602, the money which is outside there, minus the old receivable, 657, 534. And then we multiply these with any interest on loan provided in the question. Any interest on loan which is provided in the question. So in the question, what do we have, ladies and gentlemen? Do we have any loan facility? Do we have any loan facility? Yes. Accounts receivable are financed by an overdraft at an annual rate of 7%. So times 0.07. So this is a cost we are suffering ourselves, times 0.07. So once you reach here, you are almost getting all the marks. Once you reach here, you are almost getting all the marks. So how much do we have there? Approximately the increased finance cost because of increase in receivable. Approximately, how much do we have there? Approximately. I'm alone, but I will overcome. So approximately, we are getting 10,155, isn't it? Approximately 10,155. And now once you reach here, do us a favor. Give us what we call a cost benefit analysis now. Yeah, give us a net benefit schedule. Give us a net benefit schedule of this entire transaction. Give us a net benefit schedule of this entire transaction. Give us a net benefit schedule of the entire transaction. So you're looking at benefits versus what here? Costs. So we start with benefit. So the benefit, you always look at increased contribution. Increased contribution. So remember our sales grew by, if you remember our sales grew by 300,000. Remember this is sales, but you want contribution. And your examiner will give you the contribution ratio. The examiner will give you the contributions ratio. The examiner will give you the contributions ratio. How much will this policy now contribute? So this examiner gave me the contribution somewhere. Yeah, he told me contribution represents 60% of sales, and I want the increase. So 60%, my good students, of that increased sales. So times 60%. So then this one here will give me what figure, if you don't mind? The increased contribution. The increased contribution. Now they are no longer talking to me. I don't know why. They are no longer talking to me. 180,000. 180,000. So in some questions, we normally have reduced bad debts. This question does not have bad debts, so we go to costs. So costs, we can see one disadvantage, the increased finance cost, the interest. And you guys gave me a figure, if I remember very well, you gave me a figure of 10. Was it 10,155? 10,155, isn't it? Yeah, 10,155. And then, ladies and gentlemen, apart from that, we have another disadvantage. We have increased cost because we're going to produce more. We're going to produce, there is an increase in the general cost. What have they told us about? Because we're going to produce 6.3. There are expenses which will arise because of the volumes increasing. Because of the volumes increasing. Yeah, so we are told here that the company expects that these changes will increase annual credit sales by 5%, while also leading to additional incremental costs equaling to 0.5% of revenue. So 0.5% of the revenue. So the increased cost will be 0.5%, of course, of our new revenue, which is 6.3 million. So can somebody give me this? Can somebody give me this? Yeah, whenever you have the volumes increasing, we shall have the general cost increasing as well. And the examiner will give you that. There are basically three key things here. So in this case here, B and Laura, they're giving me 31,500. The other one that I will never ever forget, remember we are trying to entice these guys here to pay much earlier. So we shall have discounts given. These are your costs, you must absorb them. So have they given me the criteria for the discount? Discount, what have they told? This is the last one. What have they told me about discount? So the discount that they have told me, ladies and gentlemen, is here. Ulnad company plans to offer an early settlement of 1.5% for payment within 15 days and to extend the maximum credit to 60 days. Great. So then we know that we are going to have our 6.3 million. Out of these 6.3 million, we shall be losing 1.5%. But remember, it's not all people are going to take advantage of this discount. It's only 30%. It's only 30%. So could you be kind enough by giving me this 6.3 million? 6.3 million. So it's a cost on you. It's a cost on you. So how much do we have there, my good students? How much do we have there, my good students? So remember the 6.3 and the discount is 1.5. And then of course it's 30%. It is 30%. 28,350. So 28,350, and that is it. So come and give me the net benefit. If positive, then we recommend the proposed policy. If negative, we say no. If positive, we say, okay, we are recommending this. So the answer given to us by ACCA is a net benefit of 109,995. Then the proposed policy will therefore increase the profits of the company. And there we are together. We recommend it. We recommend it. We recommend the policy. We recommend the policy. We recommend the policy. So then we have come to the end of a particular session, ladies and gentlemen. Yeah, it was to be as short as that, short and sweet. I'm looking forward to having another class with you tomorrow. I'll be able to give you a few FM classes. Of course, I'm so sure you have handled FM so well. Mine is only to come and inspire you up, inspire you to be able to pass this thing on your first attempt, and that is RCM for you. That's RCM for you. And remember, you don't have to get like all the marks. It's about you tackling a few things under there and you will overcome. And as we said up there, that RCM Online College is the best college in East Africa. Best college in East Africa. I hope you guys are in agreement. Most colleges closed long time ago. As we walk with you to this exam, to the very exam day, we shall teach you to the very exam day. Of course, short sessions, as we also allow you to do your own things, your own studies. And of course, were it not for you, will not be up there. We are up there because of you. Thank you so much for making us the #1 college for CASNEB courses in East Africa. So have a lovely afternoon. Bye. Bye. Bye-bye. Bye-bye. Practice whatever you have done here. Thank you so much. See you later. Yeah, I will post, yes. I will post, yes. Thank you, Abel. We shall overcome. I will be able to tell you where they are on the LMS. I'll be able to tell you. Quinta, I can't remember seeing your question. I always aspire to answer all questions. Even if I don't answer here, Quinta, then you have my number. And as usual, I always pick my. Yeah, I'll be able to upload them. I'll tell these guys here to upload them. This is the first one for FM, right? This is the first one for FM. Yes. Thank you so much. Be blessed. Bye.